So on to our next part of our program. I'd like to introduce Mark Holloway is our Chief Investment Officer. Mark has actually been at the bank with me for, we calculated, 23 years. So Mark and I have been together for quite some time. Mark was a critical part of the growth of the wealth management and trust area. At the time he joined the bank in the trust area, we were about $200 million in assets. He came over to head the helm and use his investment expertise. Today, we are at $2.7 billion in assets. So his responsibilities over the years have grown, but he has been instrumental in helping us grow and provide those services to our clients. Mark earned his MBA from Bellarmine University. He also received his undergraduate degree in accounting from the University of Kentucky. I used to throw darts at him at this because I was a big U of L fan. I'll just be quiet today. And plus, my daughter is now at UK. So I really, between what's going on at U of L and my daughter at UK, that's a great school, Mark. Go Cats. Mark is responsible for the equity and fixed income selection, quantitative analysis, and he also is an advisor to the Asset Liability Committee and the Interest Rate Committee for the bank. So he serves an important role not only for wealth management and trust clients, but also for the bank overall. Mark is a member of the CFA Institute, the CFA Society of Louisville, and has served on a board that's very near and dear to his heart, is the Hyman Settlement School, if any of you are familiar with that, in Eastern Kentucky for over 20 years. So Mark also gives back to the community as well. Mark is very passionate about using his expertise to help clients meet their goals. Without further ado, I would like to introduce Mark Holloway.
Thank you, Kathy. Are we on? Yes. Good. The format's going to be a little bit different today. Who here has been to one of our economic seminars or SYP on the road before? Okay. Well, this is going to be a little bit like SYP on the road, but I get all 30 minutes today. This is going to be a little bit different than what you're used to if you come to the economic seminar. I'm going to talk a little bit about the economy and the outlook for the capital markets, and I'm also going to talk a little bit about what to do if you're sitting on the sidelines investment-wise. Then Dr. Donald Ratajczak is going to come up and talk more in depth about the economy. So a little bit different this time. Same type of format though. I'm not going to use a lot of statistics. It's going to be very much an interactive event, so you have to participate. Those are the rules. So let's get interactive right away, because I think you all probably, as business people, know more about what's going on in the economy than all the government statisticians put together. Who thinks we're going to have a recession in the next 12 months? No one. Oh my God, we may have to rethink this. Beware the lone wolf, right? Who thinks that interest rates are going to go up between now and the end of the year? A lot of hands. Well, the Federal Reserve has kind of promised that, actually. If you look at the Federal Reserve Fed Funds future rate, they indicate that they're probably going to go up sometime in December. Who thinks that we're going to see the stock market continue to go up? Lots of hands. Good. Good. Who has cash to invest now? You were worried about the election. Oh, a lot of people are admitting to it. Good. Okay. Do we have any politicians in the audience? None? Good. I can talk freely. Who thinks that President Trump is going to make it through his first term and serve a second one? Make it through the first term. You think he'll run for a second one? Not as many hands. Okay. Okay, let's talk a little bit about the economy. And I'm going to talk very little about the economy, and I'm going to do it in the context of the recent election. We have been growing at a very low rate for a long time. And if you've been coming to these things, you know we've been on this slow growth bandwagon for about 7 or 8 years. Last year we changed our tune a little bit, talked about maybe a little bit better economic growth. I think we're probably going to see a little bit better economic growth going into 2018 as well. The surprising results of the 2016 election gave us a president that is much more business savvy and much more business empathetic, if you will, than previous administrations. And he has surrounded himself with people that believe that a lot of our social and economic ills would be cured to some extent by faster economic growth. So it's the goal of this president to have faster economic growth. How is he going to do that? I got to turn on the pointer. Well, you can think of the president's program for faster growth as having 4 legs. And the first one is tax cuts. He wants to cut taxes for corporations and for working Americans. We just saw, recently released, some of the skeleton of the president's tax plan. And he is reducing and simplifying the tax code for everybody who pays taxes. He's also reducing corporate taxes pretty significantly, and he's simplifying things by reducing a lot of deductions. And if you think repeal of Obamacare was a tough issue, wait till we get to talking about taxes, because just about everybody's ox is going to get gored in this in terms of reducing the deductions. The SALT deductions, the state and local tax deduction, big one that everybody is going to be upset about, particularly in the high tax states like New York and California. So reducing taxes puts more money in everybody's pocket. And more money in everybody's pocket means we get to spend money. And I've been up here for 23 years telling you that 70% of our economy is us spending money. So anything that puts more money in our pocket is good for economic growth, right? I like it when everybody nods their head. Thank you. Second part, repatriation of overseas dollars. The president wants to have a one-time reduced rate of taxes on money that's held in bank accounts overseas by domestic corporations. And there's a lot of it. Actually about $3 trillion in money held overseas. Everybody knows the story on Apple and the $280 billion they have in cash, most of which is held in banks overseas. You may not know, but Microsoft has about $17 a share in cash on its balance sheet, most of it held overseas. How would that stimulate economic growth? Well, hopefully what would happen when that money came back is it would be invested in new plant, new equipment, and hire workers, and that would be very positive for economic activity. Third thing, third leg of the stool, regulatory reform. And this is something that's near and dear to all the bankers in the room's heart. One of the fastest growing areas in terms of people at most banks is the compliance and audit area. And those people don't bring in any loans, they don't bring in any deposits, they don't handle any accounts. They are a dead weight expense on our cost structure. So if you reduce regulation, you would be reducing some of those expenses and making our operations much more efficient. Who here in this room, getting interactive again, has bought a house in the last year or 18 months? Anybody? Was the loan process anything like you remembered? No. Very, very difficult to get a loan these days. So anything that would free up lending practices a little bit would be good for the economy. And the other area that would be positively impacted by this is the energy area. A lot of the regulation that came down the pike affected domestic energy production. And if we increased domestic energy production to the extent that we became energy independent, that would be very positive for the economy. And then the final thing is infrastructure spending. The president has talked about spending about $1 trillion in repair work for dams and bridges and roadways. And he's going to do this 2 ways. This is sort of a la the Obama administration. He's going to directly subsidize and he's going to provide tax cuts to the companies who participate in these programs. And that would be very positive for economic growth because, again, it would hire people and put money and paychecks in people's pockets that they would then spend and stimulate the economy. All sounds really good, right? All of these things have been used in the past, not just in this country, but everywhere, to stimulate economic growth successfully. So this is an agenda that could get us to 3% plus type growth. What could possibly go wrong? Well, if you know me at all, you know I'm going to tell you. There are some headwinds to all of this that I think is going to keep us from growing at that 4% rate. We could get to 3% probably for 2018 pretty easily, but for us to get to 4% or higher, I think there's some things embedded in our economy that are going to keep us from growing that much faster. And the first is geopolitical risks. Geopolitical risks right now are probably as high as I've seen them since the Cold War. With what's going on in the Middle East, with Korea testing nuclear weapons and firing missiles everywhere, all of this is impacting consumer and business confidence. And I think it's going to continue to impact consumer and business confidence. We could, if North Korea exploded a nuclear bomb someplace, all bets will be off on the economy and on the capital markets, at least for a short period of time. So geopolitical risks are a real threat right now. The age of the economic expansion. And I'm going to skip to another slide. We're that light blue line now. And I want you to notice two things about it. The first is it's very slow growth. We've only averaged about 2% growth for the last 8 or 9 years. And the second thing, it's one of the longer lines out there. In fact, this is the fourth longest expansion since World War II. And if we continue to grow through 2018, this will be the longest expansion since World War II. What does that mean? Well, I become skeptical on two fronts on this. The first is we have a recession in this country about every 7 years or so. We're overdue for a slowdown. The longer this goes on, the more susceptible I think we are to a slowdown. And that 2% rate of growth is pretty close to that zero line. So I worry that the length of this expansion and the slow growth of this expansion is something that's vulnerable, if that makes sense. Does it make sense? Demographic patterns. We are an aging population here in this country, and that affects us a couple of different ways. The first is an aging workforce is a less productive workforce. And so that hurts productivity and that hurts economic growth. The second thing is there's kind of a couple of things going on spending-wise that are going to hurt economic activity to some extent. One is all of us baby boomers that I'm right in the middle of, we haven't saved enough for retirement, so we're going to be cutting back on our spending and saving. The second thing is the generation, a couple of generations behind us, the next big one, the millennials, they are in the process of trying to form households, and they're kind of reluctant to do that. And when you form a new household, when you get married and buy a house, that's when your peak spending takes place. So their reluctance to form new households is something that's going to impact consumer spending to some extent. The national debt, my big bugaboo. One of the things that I think is going to be an impediment to growth, it's been an anchor to growth for the last 8 or 9 years, has been the huge amount of debt that we have. And if the Federal Reserve continues to increase interest rates, that is going to be a problem. And the reason is because a lot of our debt is very short-term in nature. So when the Fed increases short-term interest rates, they instantaneously increase the cost to service that debt, interest rate-wise. And that's a big number. When we're talking about $20 trillion in debt, a small increase in interest rates takes a lot of money out of the federal coffers that could be used for better resource development. Make sense? Federal Reserve actions. We believe that the Federal Reserve is in the process of normalizing interest rates. And they announced the other day that they are in the process of starting to unwind all the quantitative easing that they did over the last 7 or 8 years, where they've bought a bunch of bonds to inject money into the economy. Unwinding that is going to be a big supply and demand issue for the bond market. They were a big source of demand when they were buying. Now they'll be a source of supply. And when supply exceeds demand, generally prices change and not for the better. The increase in the Fed funds rate, I think, is probably going to continue into 2018. They're going to be very deliberate about this, but they are going to be increasing interest rates, and there is a direct negative correlation between increasing interest rates and economic activity. Higher interest rates generally lower economic activity. Corporate cash flow usage. What do I mean by that? Well, we're hoping that if we repatriate all those dollars, that corporations in the United States are going to increase the amount they invest in plant and equipment, and research and development, and create jobs. What they have been doing so far with excess cash flow over the last 8 or 9 years is buying back stock, increasing dividends, and making acquisitions. And all of those things kind of have a negligible impact on economic activity. So what corporations do with that money, I think, is going to be very important. And I hope there will be incentives tied to that to make sure that they spend it on things that do produce economic activity. And the final thing is Congress. Congress seems to be intent on trying to delay or block implementation of a lot of these programs. And the reason I think, and this is why I asked if there were any politicians in the room, is I think this populist government, smaller government idea that elected President Trump is something that is very difficult for entrenched congressmen to swallow, because it threatens their source of power and control and wealth. So I think they're going to continue to be reluctant to go in and approve carte blanche everything that President Trump wants to do. Make sense? What do we think about the outlook for the economy after all of that? I think that a lot of these things are going to eventually come into play to one degree or another, the positives that Trump wants to do. And we're probably going to see better economic growth in the second half of this year, barring another bad hurricane. But I think the fourth quarter is going to be better. The third quarter will probably be impacted by hurricanes, and I think Dr. Ratajczak is going to talk a little bit more about that. But I think 2018 looks like a good year. It's not going to be a recession year. It's going to be a year of 3% type growth economic-wise. So you don't have to call me Dr. Doom anymore. The reason for this is because we do have a business-friendly president. And he understands the trials that you as small business owners go through and us as banks go through. That's going to improve business and consumer confidence. We're going to get employment gains that are going to continue. We've been getting some nice increases in employment, and that's always positive for the economy. The possibility of tax cuts and lower regulation is a big deal. And energy independence, I think, is a big deal as well. So all of those things are going to counteract some of the things we talked about that are headwinds. We won't get 4% growth, but I think we're going to get something 3 or a little bit better. What's this mean for the capital markets? Let's talk about stocks first. There are several positives and one really big negative about the stock market. When I asked if we thought the stock market was going to continue to go up, a lot of hands went up. I think you're probably going to see the stock market continue to go up too, but maybe not at the same pace that we've had. After the election, the last year or so, the market's up about 17%. So far this year, up about 14%. Those are big numbers. Those are good numbers. The positives that have been affecting this, that are probably going to continue to positively affect it, are first of all, low bond yields. Getting interactive again, we've got a yield of about 2.25, I guess, on the 10-year Treasury. Who wants to buy the 10-year Treasury with a 2.25% yield? Or would you rather have a common stock of a blue chip company that's conservatively financed, that pays a dividend and grows a dividend every year? Who wants the stock? Who wants the bond? Again, we have consensus, and I'd hate to see consensus that strong. But low bond yields don't provide any competition for stocks right now. And I think they will continue to not provide any competition for quite some time. Second thing is increasing corporate profits. We've had a pretty good corporate profit year this year. Earnings are up about 6% or so. And I think we're going to have a pretty good corporate profit year next year as well. Particularly if we get lower taxes on corporations and if we get faster economic growth. Those two things will spur corporate profit growth, and corporate profit growth is like the fuel that can drive stock prices higher. That's the key ingredient in a higher stock market. Corporate liquidity. I have not seen in the 41 years that I've been in the business corporate liquidity be as strong as it is right now. And if we get a reduction in taxes and repatriation of earnings, that'll be like corporate liquidity on steroids. Why is that important? Several reasons. One, corporate liquidity allows corporations to buy back their own stock and increase dividends, and that's positive for shareholders and positive for stock markets. It allows corporations to invest in research and development, which produces future corporate profits. It allows corporations to make strategic acquisitions, which increase market share, which are good for future corporate profits. So this corporate liquidity thing is a big deal, and it's very important. It's one of the things that's been driving the stock market. A lot of share repurchases have accounted for that big increase in earnings this year. The stable political and economic environment. And this is going to affect both U.S. stocks and U.S. bonds. There isn't any place on earth that's as stable politically and economically as the United States. And so there's been a worry about Korea and all of these geopolitical risks, and that's caused a flight to quality. And there isn't much more quality than buying U.S. governments or U.S. stocks. So I think the fact that we have a very stable political and economic environment is something that's going to port overseas dollars into the U.S. markets, and that will be a source of funds that could drive stock prices higher. Now the negative. Just like in real estate, it's location, location, location. In the stock market, it's valuation, valuation, valuation. And valuations on U.S. stocks right now are as high as I've seen them in a while. And any measure, whether it's PE ratios or price compared to sales or price compared to cash flow, we're well above the normal or average for the last 50 years. In fact, we're far enough above the normal right now that historically speaking, buying stocks at these valuation levels has only produced a small single-digit type return. So the one headwind that I see in all this, unless we see some pretty big increases in earnings, is that valuations could limit the growth of the stock market going forward. Make sense? What about bonds? Again, positives and negatives. The first positive is low inflation, and this really impacts longer-term interest rates. There is a very direct correlation between inflation and interest rates. As inflation stays low, generally interest rates can stay low, and we have very low inflation right now. So that's a very big positive for the bond market. This flight to quality that I talked about with the stocks happens with the bonds too. And it's going to be exacerbated in our bond market because our bond yields are much lower than what they are in most foreign developed countries. You get a 0% interest rate if you go to Germany or some of the Scandinavian countries. Compared to that 2.25% on our 10-year, that looks pretty good to me. Politics. What do I mean by that? Well, I think it's in our best interest to try and keep interest rates as low as we possibly can, because increasing interest rates increases our budget deficit. And no matter what we say about those congressmen that we have, congressmen and women, they don't want to see bigger budget deficits. So politically speaking, they're going to do everything that they can, I think, to encourage the Fed to move at a very deliberate pace and to encourage longer-term bond yields to stay low. The low level of foreign interest rates we've already mentioned, and the emphasis on fiscal policy. I think one of the things that the Trump administration is bringing to bear on our economic situation is a de-emphasis on monetary policy. Monetary policy has become very asymmetrical to me. We took interest rates down very quickly to almost zero and only experienced 2% growth. I think the opposite could occur as the Federal Reserve increases interest rates. It won't take, because of all this debt, much of an increase in interest rates to kind of slow down this economy. So the asymmetry is we took interest rates way down and didn't achieve growth. We may interrupt growth pretty quickly if we raise rates too much. And I will tell you, Federal Reserves everywhere throughout history have been very good at throwing liquidity at economic problems. What they haven't been as good at is unwinding the liquidity. And unwinding the liquidity is going to be a big trick this time, because the Fed's balance sheet has swollen to a huge number. And when they start unwinding those bonds, they can either move too fast and interrupt economic activity, or they can go too slow and possibly create some inflation. So the Fed has a big burden right now. They're walking a very fine line, and I think they're going to have to be very exact in how they unwind all this. That's the negative, the Federal Reserve. How are they going to do this? And I don't think they have a real, I think they have a plan. I'm not sure whether the economy is going to get interrupted by it or whether we're going to get inflation from it. But they have to walk a very fine line. And then this low level of interest rates. What do I mean by that? If you have an existing bond portfolio and you've got some 30-year bonds, and interest rates go up 1%, who thinks that's possible? You gotta participate, remember. What is the decline in the price on that 30-year bond if interest rates go up 1%? Well, this chart shows you it's about 17.5%. What if you say, well, I'm pretty conservative, I only own 10-year bonds? Well, the decline on those is almost 9%. So we've been in a bull market for bonds for a very long time. And I can tell you, customers, if they see returns from the fixed income market in a short period of time, over a short period of time, that approximate this, they're going to get pretty discouraged. Buying bonds at this low level of interest rates, you buy them for one thing, and that's diversification. They are not total return vehicles. And in fact, they could be total negative return vehicles. I worked with a person at Citizens Fidelity many years ago who called fixed income negotiable instruments of confiscation. And I think this chart pretty much proves that. So interest rates going up will be very negative for existing bond portfolios. And I don't think we're used to that. We've been in a bull market for bonds for 30 years. Okay, I want to address what if you're sitting on the sidelines right now. A lot of people held up their hands when I said, who in the room has money to invest? Why aren't you investing? Worried about a correction in the market? Well, you probably should be. Because we generally have about a 10% correction on an annualized basis. And we haven't even had a 5% correction in a very long time, about 18 months. So everybody, I think, is worried about the economy. I have a lot of clients who told me they were worried about the election. Everybody's worried about these geopolitical risks. What would happen if North Korea sets off a nuclear bomb someplace? So everybody's worried. So I'm here to try and take some of the worry about possibly investing some of this money. You've only got three choices, right? You can continue to sit on the sidelines. And if you've got that money in a deposit at Stockyards Bank, thank you very much. We appreciate it. Or you can dollar cost average in, or you can go ahead and just plunk the money in. As you know, I'm not a big advocate of timing the market. I don't think anybody can do it. So sitting on the sidelines is really not an option for us. So I'm going to show you, break with tradition, and show you some charts and statistics that hopefully will help you overcome your fear of investing. The first is time horizon. Who here has a 15-year time horizon? Oh, come on. I've got a 15-year time horizon and I'm not feeling very well this morning. How many times in rolling 15-year periods since 1926, so in other words from 1926 to 1941, and 1927 to 1942, and 1928 to 1943, and on and on and on, how many 15-year rolling time periods have we had a negative return from the stock market in the United States? Zero. The answer is zero. So if your time horizon is 15 years or longer, you really don't have an excuse for being out of the market. No one has a crystal ball. But being out of the market is something that can hurt you performance-wise. We have a policy in our department not to try and time the market and not to hold cash. And the reason is because over the last 20 years, the average return from the stock market has been something close to 8%, 7.8, 7.9%. If you missed the best 10 trading days in that 20-year period of time, you cut your return in half to 4%. If you miss the best 30 days, your return goes to zero. So So for that reason, we feel like our role as professional investors is to make sure that you're there to participate in those days that make all the difference in return. Make sense? Worst days for the S&P. Gosh, what if I put the money in and the market goes down 5 or 6% the next day? Well, I will tell you there's been 17 times that the market has corrected more than 6% in one day. Do you know what the average annual return is 1 year after that 6% correction? It's 21%. Of those 17 times that we've had those corrections, 15 of them have been positive 1 year later, return-wise. So, corrections aren't really as painful as they appear when they first happen, because they historically, if history holds true, have been an opportunity to get into the market. So, very powerful chart here. An oldie but a goodie. And I'm going to give you one last anecdotal piece of evidence. We saw a study, actually Shannon brought it in the other day, and it showed two individuals. And they had each inherited $100,000 from their crazy eccentric uncle. And they inherited this money on October 16, 1987. Does anybody know why we chose that date? October 19th became known as Black Monday. The market dropped 508 points that day, 21%, huge drop. I remember it very well because it was the first day back at work from my honeymoon. Let's say that you and your sibling got that $100,000, and you on the Friday before Black Monday put it all in the market. The broker convinced you, let's just buy a basket of stocks, or let's just buy some S&P 500 index funds. Let's just get in. And your sibling said, you know, I'm worried about the economy, I'm worried about all these geopolitical risks, I'm worried about the election, I'm really scared. I don't want to invest this money all at once. I'm going to put $1,000 a month in over 100 months. Well, Monday you probably got a call from your sibling. And they're gloating because they still have $99,970 and you now have $79,000. Let's fast forward 1 year and assume, or to 12/31/16. And let's assume that you didn't take any money out of the market, that you just let it ride. Who has more money? Well, your sibling's got a little over $1 million. You, on the other hand, have $1,300,000. So my moral on all these stories is that time in the market is what's important, not trying to time the market. So it's almost always a good time to invest. The last thing I want to do is thank you all for being here today. I see a lot of friends in the audience. I want to thank you for being here on this beautiful morning, and I also want to tell you thank you for your business. You are kind of our business reason for being, and Stockyards Bank is like a family, and you all are part of that family. Thank you.
Thank you, Mark. As always, he does a great job at presenting a sometimes complicated topic into some takeaways. We are going to take a very quick break. Terry Moore is a master on keeping us on time. As she said, I talked too much in the introduction. So we're going to take like a 5-minute stretch break, bathroom break, coffee, and then I'm going to call you back in. So anyway, thank you, and we'll come back here in about 5 minutes. It's going to be a quick one. Thank you. Okay, I hate to be the one that interrupts your discussions and nice conversation, but I promised Miss Terry Moore we would stay on time. So if everyone would find their way back to their seat. And as we're waiting for the other folks to find their seats, please fill out the card that's in the seat. We are going to have 2 drawings. Sure to be great drawings at the end. You don't want to miss out on that. We've also had several people ask us about Mark's presentation, the PowerPoint. If you would like a copy of that, if you would just make a note on that card, we'd be more than happy to email you a copy of the presentation. So at the end of Dr. Ratajczak's presentation, we'll be open for questions, and we'll also collect those cards, okay? So, looks like everybody did pretty good. So we're gonna go on and get started. We are delighted today to have Dr. Donald Ratajczak with us. He is a consulting economist with Raymond James. He is one of the leading economic forecasters in the country, serving as the Regents Professor of Economics at Georgia State University, having retired in 2000 after serving 27 years as Director of the Economic Forecasting Center in the J. Mack Robinson College of Business. He produces regular publications forecasting short-term, national, and financial conditions. He has been very, very successful over the years with his accuracy in forecasting the U.S. economy and has received numerous awards and accolades for his forecasting ability. Dr. Ratajczak has been quoted and interviewed extensively by both the print and the broadcast media, including the New York Times, Journal of Commerce, Business Week, Fortune, the Wall Street Journal, Newsweek, Time, the Los Angeles Times, NBC, CNBC, and CNN. Wow, quite a list. He received his Bachelor of Arts degree from Haverford College and his Doctorate of Economics from the Massachusetts Institute of Technology. We are thrilled and delighted to have such a person with great accolades here today to share with us, and I love his title for his topic, More Good Than Bad Remains in the Economic Expansion. We all like that. So without further ado, I'd like to introduce you to Dr. Ratajczak.
Thank you very much. First of all, when it says I retired from Georgia State in 2000, that doesn't mean that I was old and had to take my pension. It basically meant that I got so involved in the private sector that it was time for me to move out of academia and do private economic activity. I just wanted to let you know that because someone asked me how old I am, and I said, you know, I'm at an age that you don't ask that anymore. Enough of that. I'm trying to think how to start here. I do not use slides, and I'll tell you one of the reasons why I do not use slides is, first of all, the audience is too concentrated on the slides. I like them to concentrate on what I say rather than the pictures that are presented. But the second reason is I'd have to change them too much, especially this year. I mean, you're sitting there and you got hurricanes, you got what may or may not happen in Washington, you've got what is the Fed doing here, and you got people are now recognizing that we're not the only central bank in the world, and that we now have to ask, what are the other guys doing? Because that has an impact. If you remember, the dollar was roaring going into the first quarter of this year, and now it's been fading, and is still, I mean, I guess the last week it had a little bit of a bounce, but generally the dollar is now weakening, and all of these patterns are related to our central bank activity versus other people's central bank activities. And they all have implications on our economy, and especially on our investment environment. Emerging markets, by the way, have outperformed the US market for all of this year, basically. Did terrible last year. Why? The dollar was rallying. You don't, when the dollar is strong, most emerging markets are financed by dollar-based debt. And so what happens, the dollar's rallying, wow, that debt is getting very heavy in emerging markets. Dollar fades. I mean, this is simplistic. There are a lot of other things, But the first thing, whenever you talk about international investing, is what's the dollar doing? And in fact, when I do my write-up, and I write every week, and I do talk about the stock market among other things, I start out by saying the dollar did X this week. And therefore, the stock markets abroad need to do at least X in order to provide US-based investors with a return. So if you see, hey, the European markets are up 1.5%, but the dollar is up 1.5%, well, actually, I always have this wrong. Basically, yeah, if the dollar's up, that means what you're getting out of Europe has been depreciated by 1.5%, so no big deal. It's a wash. You haven't gained anything. So that's basically what I do first of all. Anyway, enough of that, and it depends upon the central banks. So I'm going to talk about all these things. But first of all, let me start with hurricanes. I hate to start with hurricanes. This may be the worst year in history for hurricanes. It's not clear yet if you do the calculations. The worst year was Katrina, Rita, and Wilma, all happening in 2005. And that was a hurricane event of $250 billion. Now, not for insurance companies. The insurance portion of it was a significantly smaller amount, basically because most of the damage was flood damage, and most of the people did not have flood insurance. Okay? And by the way, Harvey was clearly that kind of an issue as well. Most of the people in Houston, I don't understand why, because when you get a 2-inch rain, you flood out the city. But, and when you get a 50-inch rain, the city is a big lake for a long period of time. To be perfectly honest, there's nothing surprising about the fact that Houston flooded. There's a lot surprising about how long it was flooded and how deep the flood was, and therefore how much damage was created. But Houston is really a flood-prone area. So anyway, but despite that, most of the people didn't have flood insurance. That's going to pose somewhat of a problem there. By the way, if you hadn't noticed, the absence of flood insurance means you can't recover on the damage of your house. However, flood insurance is not a factor in ruling out claims on automobiles. So almost all the automobiles damaged in the Houston area will be covered by their insurance. Just wanted to tell you the difference between the two going on here. Now, Irma, that was wind damage to a large extent, or wind. If the water is driven by wind, you are covered. If you're flooded, you're not covered. But if the water, so storm surge, you are covered. And the insurance people will talk about all this kind of stuff and figure it out. But quite frankly, Irma, which probably was a slightly smaller hurricane event in many ways, certainly in the form of damage, probably is going to have a larger insurance impact because more of the housing damage is covered, okay, than in Houston. Although in both cases, the automobiles will be covered. However, the figures I've heard is that Houston automobile damage is about 500,000. Irma, Florida damage is about 200,000. And we're not even going to talk about Puerto Rico because everything is damaged there. It's just a real mess in Puerto Rico. And by the way, is that part of the United States? Absolutely. Absolutely. Not only are they citizens, but their performance counts in our GDP accounts. And they certainly will be impacted. You'll see it this week in the initial claims that will come out tomorrow because of the damage and the dislocations that occurred in Puerto Rico. Okay, so basically, yes, they do count. and so do the U.S. Virgin Islands. My son was looking for a property in St. John's. He's still looking, he can't find it anymore. But thank goodness he didn't get that serious about it. Yeah, it's a dreadful amount of dislocation. Anyway, 2005 was about $250 billion of total economic damage and dislocation. It looks like, and by the way, I'm talking about current dollars. So it's adjusted for the moderate amount of inflation we've had in between. Today it's probably about the same. Harvey, Irma, and Maria have probably done about the same. Maybe a little bit more if you look at the infrastructure problems that Puerto Rico is going to have to face. Okay, so what does that mean? Well, hurricanes are interesting. I mean, they're interesting meteorologically, but they're also interesting economically, because what happens is you have a negative followed by a positive, which, by the way, is where most economists stop, followed by a negative. Very few people explain that last tail. Okay? First of all, the negative, obviously. Dislocation, damage, can't work because your employment is shut down. And so you get the dislocations, you get the increase in unemployment. We saw some of that with the August automobile sales, which were surprisingly weak. But who is out there buying automobiles when you're flooded? So basically, 4% of the economy of the United States was somewhat impacted, or I shouldn't say the economy, but 4% of the automobiles buying economy was impacted by Harvey. By the way, 9% of the construction economy was impacted by Irma, and we haven't seen the Irma data yet. That data is going to start to flow in because that's a September-based data. And then Maria will be also a September-based factor coming into the figures. All right, so the first negative disruptions, some destruction. By the way, the federal government has not yet acknowledged the magnitude of the destruction. It will do so. That August personal income, which was reported up to 0.2, will eventually, it may not be until they come to the next year, but it will be eventually revised down to a negative personal income. Why will that be? Because rental income, our device, people who own a home are assumed to be a business that has purchased that home to rent to themselves. And that's the way we approach it in the accounts. When that business is destroyed, obviously there is an unwanted depreciation of the asset. In Katrina, the impact was $110 billion on rental income. Now that was mostly homeowners with their destroyed properties. We're probably talking about a magnitude close to that. And some of that will be revised back into that personal income figure in August, and others will be put into September. Okay, anyway, that's the negative effects. It's significant, but we've already suffered them. Now we're starting to already see the positive effects. The surprisingly quick response by the insurance industry on automobiles. Surprisingly quick, which, unlike Katrina, which lagged into almost the end of the fourth quarter, Houston rebounded dramatically. In fact, in September, Houston automobile sales were up 109% from the previous year. Huge increase in automobile sales. One of the reasons why you are now hearing that automobile sales, after a 16.1 million annual rate of performance in August, remember, depleted by the flooding, it was 18.5 million seasonally adjusted in September. And that, by the way, that's one of the figures that caused me to change. I started out saying there would be a drag on retail sales because of all the evacuees out of Florida. Obviously, they weren't buying their normal activities in Florida. As it turns out, they were buying them elsewhere, so it wasn't that big an impact. But in fact, there looked like there would be some negative retailing activity caused by the evacuations out of Florida. But now, with these automobile increases, we're probably going to have a September retail sales gain of 1%. A big increase. It will not be replicated in October. There's no way we're going to continue to sell automobiles at that rate. But as I said, the insurance companies were very quick at sending out their checks for the automobiles. Not as quick on housing, but very quick on the automobiles. And this has dramatically altered the data. Okay, so that we're going to see a lot of that. Obviously, there's going to be rebuilding, there's going to be construction activity. We're seeing the construction activity pick up. In fact, today's ADP report indicated that although service was off, you expect that. When you shut down Florida for a week, the service economy is going to be off a bit. Okay, when I say off, it grew, but it grew less than normal. However, the goods producing, the construction people were already working when the ADP people started to do the surveys. They certainly were working in the Harvey area and were starting to work down in the Keys in Florida. And so you already saw the construction pick up, and you're seeing manufacturing pick up. I mean, people have to replace those appliances and all that wood and other stuff, the drywall that's now wet as heck. They all need to be replaced. And so you see all of that activity picking up. And that was already present in the September release that came out this morning. The numbers weren't good because the service economy was slowed down so much. Next month, the service economy will pick up again, and we'll probably have higher than normal employment rates. By the way, if you want to know, it was 135,000 increase. Still not a bad number, but certainly a dramatic slowing from the 228,000 of the previous month. So that's the second hurricane effect. And that's coming on relatively quickly, except in Puerto Rico. And the problem in Puerto Rico is not effort, it's the magnitude of the destruction. There's no power. The grid went down. In these other places, trees cross lines. So you get the linesmen out, they have to remove the trees, put the lines back up. Yeah, it takes time, but your basic power sources were not impacted. Puerto Rico already had a weak grid system, and the whole grid collapsed. And this makes it very difficult to get things going. Then you have all of the roads covered, some of them totally destroyed, so it's hard to move goods around. They need major infrastructure investment to get started in their recovery. That's why it's been somewhat slower than in other than the recovery elsewhere. By the way, I flew in here with a fellow who had a house just north of Key West, and he said the hurricane just came straight for him, and his roof was off. His roof is gone. He doesn't know where it went. The house is concrete, so the structure's still there, but obviously with no roof and a lot of rain, there's massive damage. One other thing he told me, his property before the hurricane came forward had 80 trees on it. Today it has 7. It basically, and we've seen satellite pictures of what happened in the islands, it denuded the area. It just took out vegetation. Just amazing amounts. But Key West, by the way, is already operating. In fact, I said, "What are you doing?" He said, "Your house is gone." And he says, "Yeah, it is." And fortunately for him, for once, he was happy to be on the road. And so he sat there and said, "Wow, you know, I got a place that I rented in Key West. Key West is operating." So just north of Key West. And the US 1 was not closed. I mean, it was closed because of emergencies, but the road is operational. And that's very critical to the Keys. So they can do things, and they will do things, although he still didn't have power 2 weeks after. Still doesn't have power down there, but that's a special problem. Anyway, we're going to be rebuilding into the fourth quarter. That fast recovery of automobiles will probably eliminate the negative impact on the third quarter. So we already got some of the recovery into the end of the third quarter. And I'm now estimating the third quarter is going to come in at slightly over 3% growth. Then the fourth quarter, we still have a lot of recovery coming on, so we'll be well north of 3% growth, even though the automobiles can't sustain those rates of gain. Okay? Then we'll probably have a little slowdown coming off of those very high activities. Now, what's this? I said negative, positive, negative. What's the second negative? Well, the hurricanes took out $250 billion of wealth. All right, yeah, we replaced it, but how do we replace it? By depleting financial assets. Insurance companies depleting their insurance pools, the private individuals depleting their retirement savings, or some other factors involved. That's how we replaced the wealth. We restored the physical wealth at the expense of the financial wealth. And by the way, the government is going to increase government deficits. And we're probably talking about north of $100 billion of special payments by the federal government for this hurricane season. And that's $100 billion not anticipated in the government debt. So, you know, regardless of what the interest rate changes do to the government debt, this is an expenditure that is going to be impacted upon the debt. And by the way, if you think, well, I guess we'll have to rebuild these areas at the expense of other government expenditures, haven't been watching Congress lately? What have you been seeing them cutting back on? So basically, no. This is debt being spent. And what does it mean? What it may mean is that in the future, we don't spend as much on infrastructure. The $1 trillion becomes $900 billion. Okay? So there is a cost. There's a government cost. There clearly is a private cost. And the insurance pools had to be rebuilt. And by the way, they won't be rebuilt by premiums only rising in Texas and Florida. I wrote somebody and they said, "Are you for real?" Because I said the people in Alaska will be paying higher premiums. And the answer is yes, they will, and so will you be paying higher insurance premiums than you otherwise would be paying, because the insurance pools have to be replenished. Who knows when the next $250 billion hurricane season is going to show up? And what good is your insurance if they can't pay for it? So basically, yes, it's going to be a drain, a small drain, but it'll be a drain on all of us. Okay? So, bad, good, bad. The net effect, when you get down to it, people say, "Oh, the hurricane's good for the economy." No. Come on. Anyone who says that is stupid. Hurricane's not good for the economy. All right. It may give us a little bit of a burst for a short period of time. Okay, so that takes care of the hurricanes. Quickly, I'm not going to say a lot about Washington. but obviously they're having trouble making decisions. I appreciate that list of all. It's a pro-business president with a pro-growth agenda. That is correct. There's no way I'm going to argue that that's not a correct assessment of what's going on. However, is the agenda going to be passed? And this is a question that we had dinner and was asked me last night. Well, what about the tax reform? If it can be held together as a total package, it has a good chance. Okay? They do recognize that the initial effects of it is going to be a significant amount of deficit financing. It is not going to be revenue neutral in the short run. The presumption is it will stimulate enough growth, it'll be increasing the efficiency of the tax code, and in so doing, stimulate enough growth that over time, it will create a stronger growth path than otherwise would be the case, and this would then bring back the revenue, which initially is definitely deficit financed. Okay, this is not a tax change that is going to be balanced. And everyone recognizes that that probably has to be the case. If you're going to give some stimulus to the middle class, and you're going to make our corporate structure more competitive with the rest of the world, you're either going to have to slash a lot of other things, or you're going to have to borrow some money. And they are slashing a lot of other things, but at the end of the day, they couldn't pull the trigger on the big item, which is mortgage deductions. Couldn't do it. And since I paid off my mortgage, I wish they would. Anyway, it wouldn't affect me. So enough of that. But I understand it's a difficult issue on the mortgages. So, but as a result, to achieve both some stimulus in the middle class and competitive corporate rates, they had to end up with a deficit program. Now, what's important about that? Well, they put $1.5 trillion in the next 10-year budget assessments in order to finance this tax cut. You take away any of the eliminated, or you replace any of the eliminated deductions, and the system falls apart. So, state and local taxes, and by the way, as an economist, that makes me cringe. A tax on a tax. That's not good fiscal policy. But politically, you're not going to get this bill done if you bring that out of the bill. And so that's, right now I'm forecasting it's not going to happen. I am forecasting corporate rates will go down, but I don't think they're going to go down to 20%. Okay? And I'm right now not forecasting there's going to be a significant change in the tax burdens of the household segment. So that's where I am. And, as a forecaster, I have to put a number out. And I got to make a judgment on this. And this is not a political statement of whether I approve of the bill or not. As a forecaster, I have to say what is likely to happen. I do think this is possible, but it has to hold together. Okay? You cannot have anyone saying it's not enough. I don't want to talk about your senator. But anyway, you can't do that on this thing or it won't happen. Okay? So it's really kind of critical. All right. And I'm assuming only a piece of it gets done. I may be wrong on that. But if more of it gets done, then my forecasts get better. My forecasts aren't bad. By the way, I look at it a little bit differently. Yes, I am worried that we're talking about a 9-year economic expansion. By the way, the stock market has now been up 11 consecutive months. You know how many times the stock market has been up? 12 consecutive months? Anyone have a guess? Since we're interactive? Zero. Never has the stock market achieved 12 consecutive months of gains. If we get a gain in October, we've done it. Okay? It does bother you a little bit when you're trying to do historical records. You know, why should it be unusual? Anyway, let me get to the economics, and I'm going to talk a little bit about the stock market and a little bit about the Federal Reserve and then get done. All right. The economy. All right. What I look at on the economy is imbalances. The fact that it's 9 years old is irrelevant to me. It could be 9 years old, it could be 2 years old. Do we have inventory excesses? That's the first thing I look at. The answer is, yeah, but there are 2 areas where we have inventory excesses. And by the way, both of them are improving. One area is automobiles. The automobile industry came into the year assuming it would do as well as the year before. Last year we sold 17.5 million cars. As you know, we fell down well below that in the summer months until we got this big pop in September. And that's not going to be enough to get us back up to 17.5. But the problem was that the producers thought that they would do at least as well this year as last year. So they produced based upon that, and as a result got too much inventory. Now, most of the inventory is at the dealer's level, not at the manufacturing. The manufacturing inventory level looks reasonably balanced, but at the dealer level, there's no question that they have excesses. They are whittling them down, so that's going to be a change, an improvement. We've already cut the assembly rates, probably as low as we're going to cut them for the year. We're actually brought them down to 10.6 million automobiles assembled in the United States, and we're now up to 11.1, and it looks like we should stay above 11 so that the drag on production as a result of this inventory imbalance should not be significant from here. And the other excess is speculative oil inventory. And by the way, that inventory is coming down too. We have been well out of the 5-year range on crude inventory holdings. And we are now into that range. All right, it's popped up to the top of that range primarily because a lot of refineries were down. The crude came in, but they couldn't be refined, so obviously that's where the inventory grew. And as a result, gasoline inventories fell right to the middle of their 5-year range. So we do have speculative oil inventory holdings, but they are coming down. The futures prices are no longer encouraging for such speculation, and we expect to see those factors balancing out fairly soon. Someone came up to me and said, well, hey, what would you invest in now in terms of sectors? And as you know, the worst performing sector this year has been energy. All right? 40 bucks ain't going to make it in the energy area. But if it's 55, might be able to get some benefits in that part of the market. And it does appear, as this inventory is coming down, that we are, in fact, going to move a little bit higher. We still haven't quite broken out of the 40-50 boundary, but we're right at the top of it. And I'm hopeful that we'll be trading after we get through the heating shoulder. Not a lot of energy is demanded right now. And we start into the winter months when demand picks up again. I do expect that we'll probably be in the 55, maybe a little bit higher oil range. That's not a great increase, but enough to make things profitable in the oil industry. And remember, if we are dealing with oil independence, what does that mean about the people who explore and basically transport oil in the United States? Okay? If I can get a little bit of a price increase so that the value of the product going through those pipes is rising, and I have more flow through the pipes, it may be a decent investment. Not an investment counselor, so don't say I said go ahead and buy. I think it's a risky play, but if you like risk, it's better than gambling. All right, enough of that. Okay, so anyway, those are the two inventory holdings. We really don't have excess inventories anywhere else. We don't have excess single-family housing units. In fact, the inventory there is quite low. Unlike the last several recessions, when housing led us into it, there is no reason to think there would be a significant downturn in housing. In fact, what we're starting to see is the millennials are beginning to buy detached homes. They're beginning to do it. It took a while, way behind, but they're starting to build up. And I do see this as an encouraging pattern. By the way, what's changed? More of them are paying down their student debt and becoming eligible for mortgage loans. That's the big change that's taking place. So you're finding more millennials are becoming mortgage worthy. And we're starting to see that they really, the feeling had been, oh, they like apartments, they like to be in the center of the city. They're in the center of the city because that's where the apartments were. And they couldn't get a mortgage, so they had to take an apartment. And so now they're starting to move in that direction. I actually think single detached is going to be stronger next year than this year. Now notice I said single detached. Apartments, people are getting a little aggressive there. Might be a little, certainly in some markets we are overbuilding on the apartment side. And on the commercial real estate, we've got some problems. I mean, retail, brick and mortar. How much more brick and mortar are you going to put up when half of the brick and mortar companies are shutting down facilities? Okay? Not the best play. On the other hand, warehousing, what is Amazon all about? From the warehouse to your house. Okay? Warehousing looks great. And if we had this employment growth, we're going to have to put people somewhere to work. So your office buildings, sure. Why not? We'll see what happens with lodging, although right now the lodging numbers are still solid. RevPAR is still rising. That's the key number that people use. Occupancy rates are the highest of this cycle, although the delivery of new units is catching up with the growth of rentals. So maybe this is the last best year for lodging, but that means next year could still be good. So I'm staring at the imbalances and, all right, maybe apartments, where else? I don't see a real serious construction overhang. Now, we're talking about capital goods. Why aren't the corporations spending? And it's a very simple question. I mean, it's easy to answer, actually, because what's the capacity utilization? Heck, we're still at recessionary levels. We're below 77%. My calculations mostly say if you're below 77%, you can't raise prices. Again, another reason why inflation is going nowhere. Okay? But if you can't raise prices, why are you building new facilities? You're building new facilities if the technology is driving you. But if the technology is not driving you, you don't need capacity expansion. What we need first is the growth. So actually the repatriation, I'll tell you right now, next year the repatriation is going to go into stock buybacks and dividends. It's not going to go into capital spending. Okay? It's only going to go into capital spending when we finally cross that 77% capacity utilization rate. Start to get it up there a little bit. Okay? By the way, the travels between, the norm is 77 to 81. If you're over 81, you're probably a little bit inflationary. Under 77, you're deflationary. So it's a relatively short bound. I mean, it's a bad measure. So don't get carried away by 77. But the point is, it's below that. Okay? So there's not going to be a big increase in capital spending, although there is some technological development that requires more spending. Okay, and this will give some capacity to spend. But nobody is arguing that the corporate sector is short of spending capacity. Quite the opposite. The corporate sector has a lot of spending capacity. They just have no desire to use it. And we haven't yet created anything. Lowering the tax rates aren't going to create a desire to increase, to expand. I mean, for small business it might. And some of those, that local mechanic shop, it'll make a difference there. It's not going to make the two areas where tax reform is going to make a difference is going to be the internationals, because now they can bring money home and use it more effectively, because it's been parked out there as a result of tax consequences, and this will lower the tax penalty, and as a result they can more efficiently use their capital, and that's a positive for them. And then the small business, where the small business is paying up to almost 40% when you put state and local on top of the federal, and they'll be able to hire another person or something like that. That's where the small business and the multinationals. The rest of them doesn't do a lot. Okay? So anyway, imbalances, I'm not worried at all about the inventory. I'm a little bit worried about the household sector. Remember, they're taking a wealth hit, especially in Florida and Texas. And they may slow down their spending after the repairs. So we might worry. I don't think it's a 2018 problem. It could be a 2019 problem. It's a little early to make that assessment, but we'll have to watch for that. Okay, so the savings rate at 3.5% is way too low. Right now, I do the calculations based upon the current returns to capital, and that's the total return. So basically, capital, even though the stock market is giving you double digits, capital is giving you about 7% returns, because a lot of people do have bonds. And so basically, if you calculate with the returns to capital and the level of savings, right now the household sector has not accumulated enough capital to sustain their current living standards. They have to adjust somewhere. Either they got to get more income, or they're going to have to cut back on spending. And it's getting a little bit harder to get more income. So spending is going to be an issue. And we'll worry a little bit about that after the hurricane adjustments are done. But next year I don't have three. Again, remember, I don't think the whole agenda of the Trump administration will occur. But I have 2.8 for next year. Not a bad number. And then I'll worry about the year after, although we're going to go into that year after near 3% growth. So it'll probably still be in the upper twos in 19. And then we'll really worry about 20. But that's getting beyond my crystal ball. All right, inflation. It's going to pick up. And it's not, Yellen said it would be temporary. No. Some of it's temporary, no question about it. But one of the major drags upon inflation has been commodities, what we call core commodities. Those are medical, drugs and medical devices, automobiles, used and new automobiles, clothing, things of that nature. That core commodity has been declining 1 to 2 tenths per month. And that's what's been holding down the big inflation rates. Energy's been going all over, declining trend generally, but all over the place. All right, so that's where we are on the core area. Well, what did I just say about automobiles? Well, I mean, the sales look good now. Inventory's coming down. Do you think you're going to get the same discounts? No. Used car prices, hey, these are washed out cars. These aren't, we're buying new cars and building up the used car fleet. No, we're buying new cars because the used cars are so damaged, although you got to be careful, you might inadvertently buy a few, but you got to worry. But in point of fact, we're wiping out the used cars. It's a clunker program, okay? By the way, the clunker program worked, but it's a clunker program. Basically, we're stimulating new cars and wiping out used cars. What do you think's happening to the prices of both? Finally, lease rates can start to go down, all right? Because the residual values of the lease will finally stabilize. They've been dripping down, 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 and they'll finally be able to stabilize, okay? And that'll change the price indices. By the way, that's only one piece. What's the other piece? We dislocated a lot of people. What did they do? They rented properties. What do you think is happening to the cost of shelter? All right, most of that is temporary, but some of that is going to linger for a while. So that was another factor holding down the core inflation rates. So basically the core inflation rates are going to pick up. Now, the big unknown is, will the wages follow? And so far the wages have not followed. By the way, the employment report on Friday, I don't care what the number of jobs are because that's going to be impacted by the hurricanes. What I'm going to be looking at is the year-over-year change in wages. And if it's still 2.5, which it has now been for 5 consecutive months, no acceleration in wages at all, then you know, it's going to be a problem because inflation will pick up, and if wages stay that way, this economy isn't going to continue to expand for a long period of time. It'll get through 18, possibly get through 19, but it's going to have problems. Okay? All right, enough of that. What about the Federal Reserve? We're going to have a change. It's apparent that Yellen's not going to be reappointed. I mean, there could be a surprise, but I doubt it. Does that change the policy of the Federal Reserve? Quite frankly, there are vacancies already in the board by the, well, Yellen is out in February. If Trump replaces the 2 replacements, and then he has Fisher, which means a 3rd replacement, and then Yellen, a 4th replacement out of the 7 members of the board, you get the picture. Okay? It'll be Trump's board. Anyone want to make a guess what he wants to do? How many people think that he's going to continue to approve the current performance of the Fed? Interactive? Anybody? Actually, I do. But I guess, you know, this is, everyone disagrees with me. Well, that's not the first time. But I actually do think that'll happen. But you're right to be skeptical. And what would he do? I mean, once he starts to see where the budget is going, he may, in fact, discourage the Federal Reserve from moving interest rates up too quickly. That, in the short run, is a positive, but in the long run is a negative. Because if the inflation's picking up and he's lagging behind, he's going to have a more serious inflation problem, and therefore, again, you're speeding too quickly, have to shut down on the brakes, and that almost always creates a recession. Okay? Hopefully he won't do that. I think what the Federal Reserve is doing right now is appropriate and could avoid recession and extend this expansion for several years. But if we hold it down like Europe is, and I think Europe is wrong in what they're doing, then they're going to have to hit the gas, or hit the brakes, excuse me, and that's going to mess them up probably sometime in the second half of next year. So I'm worried about that. Okay, Fed, right now, my forecast is yes, the December's baked in the cake. We're going to get a quarter of percent. I don't think the Trump board will change the pace of liquidating the portfolio. They've spelled that out fairly clearly. The 10 billion to 20 billion to 30 billion, 60-40, 60 government, 40 non-government, or non-treasury. 60 treasury, 40 non-treasury. Basically not replacing. No selling, but not replacing. So allowing the portfolio to drip down. And over 15 months, they will get to the 50 billion per month liquidation. That is their target. And I think that will be, that's been announced and probably will stay in place. The interest, and the December is definitely going to happen, or definitely as anything can be. And then the question will be, will there be 3 moves in 18? That's what the Fed is forecasting. I'm not sure it'll happen. Okay, so that's the end of that. I'm running out of time. Let me just talk about the stock market in a minute. The valuations, we talked about valuations. The trailing PE ratio is 24. The forward PE ratio, and the forward PE ratio is that you believe the forecasts. I don't know why stock analysts are better at forecasting than anyone else. So who knows what's going to, but the forward is 19. All right, historically, by the way, and this is an interesting statistic, it's between 15 and 16. And by the way, for both. For both. It's between 15 and 16. If you're a stable economy, your forward and trailing are about the same. Okay? So 24 and 19 are a bit excessive. All right. By the way, one of the reasons why you might justify it is the 19. That's a significant improvement from the 24. Well, if you continued that line of improvement, you'd be back below the 16 sometime the next year. All right, before you get too excited about that, the 24 is because energy took big losses. And the 19 is because energy now is back to profitability. All right? So, that doesn't tell you a lot. Basically, the profit growth is now slower than the valuation growth. Therefore, the forward PE ratios don't have that downward trend. They actually have a slight upward trend. That's not good. That's really heavy excess valuations. Okay? Could we justify it? Well, find something that's historically unusual. Low interest rates. That's good. However, what's happening to interest rates? They bottomed out. They're going up. Are they going to continue to go up? If I'm right about inflation, you can't hold them down. Therefore, there is a correction sometime soon. Now, you can do everything else you want to do. You can average in, you can throw all your money in right now. You can do whatever you want. I would prefer to invest the day after the 21% decline rather than the day before, but nevertheless, I agree, you cannot predict when that happens. However, it is in risky territory. And yes, I was one of the people that raised their hand that I'm in cash. And by the way, I'm not in cash, I'm in brokered CDs. I mean, you might as well get something close to inflation on your investments. But basically, I have a much higher position in short-term debt instruments than I would normally have. Okay, I'm done. I think we're ready for whatever we're doing next. Do we have questions? Is that? She's going to do a drawing first.
So if everyone would pass their cards to the center aisle, someone will come by with baskets to pick up those cards.
But while we're doing that,